Everyone, welcome to Clive Capital's Q1 2025 quarterly webinar. It's been a year or two since we've done these, but we're getting back into the habit of doing them now again. And we're excited to kick this new series off and have you join us along for the ride, just to see what we're up to, what we're doing, how we're adapting in this crazy market, crazy geopolitical environment. So without further ado, let's see what we were up to for the first 3 months of 2025. So we're going to start off. This is our table of contents right here. We're going to start off with an economic overview, just what we're seeing in the market. There's an endless number of topics to go over, from tariffs to geopolitical situations, housing markets, and more. Then we'll go into our portfolio performance, what we're investing into currently, and how that's been working out for us. Current opportunities, what do we have open right now? Company updates, in addition to the portfolio, how we've been scaling the company, what kind of systems and processes that we've been putting in place. And lastly, what's next? What have we been working on so far for Q2? Before we get into any of this, here's our standard disclaimer that this is purely for educational purposes. We're not tax, legal, financial, investment, any such advisors. This is just educational purposes only. Just two guys dressing up, chopping it up on Zoom. That's it. So please consult your own CPAs, attorneys, advisors, trusted experts in your life. And this is not an investment solicitation or anything like that, just purely educational. So, a little bit about us, our executive team. Clive Capital helps everyday passive investors invest into private equity opportunities for superior risk-adjusted returns. We generally target 15 to 30% IRR, passive income, and tax benefits. And these opportunities can be worth anywhere from 10 million to hundreds of millions of dollars that our investors gain access to for as little as $50,000. And our lofty, larger than life goal is to help 10,000 families achieve financial independence through these passive private equity investments. My name is Keshav, one of the co-founders and principal of Clive Capital. I started in this space back in 2021, invested into my first syndication into 108 apartment units in San Antonio. That started bringing me monthly returns, and it also gave me a tax form where I could claim depreciation, get tax benefits. And to me, that was a light bulb moment that, hey, this is better than the stock market will ever be. And I'm going to do this for myself. I should do it for my family and friends and those who want to join us along for the journey. So I started Clive Capital in January 2022.
And I'm John Lai. I am Kesha's partner at Clive Capital, one of the principals. And I started investing in commercial real estate around the same time that Clive Capital started, a little bit before that, and have invested, close to 500,000 so far in commercial real estate with Clive, and continue to invest in commercial real estate. I see it as a one of the ways to balance and diversify my portfolio. And it's been a very strategic way of diversifying risk as we talk about the economic environment. We all need a level of diversification.
And with my background as a software engineer in big tech companies like Amazon and Facebook, John's more stellar background at consulting companies, finance companies, and tech companies as well. We just have experience in talking to a lot of other high earners who face a lot of the same issues. They earn really well, but they pay a lot in taxes. They have to settle for 10% stock market returns and the volatility. And we want to help you solve that problem just the way we're solving it for ourselves and our families.
Right. Very good. Let's go ahead and jump right into the economic overview. There's a lot to cover. We have had this Q1 is a doozy, essentially. Starting with the top left, talking about trade tensions. Trade tension and policy uncertainty is at historic highs. That's eroding business and investor confidence and fueling, of course, financial market volatility, which I'll talk about a little bit later. But as you know, the US has enacted sweeping tariffs, 10% baseline, as much as high as 145% on key partners like China, And these actions have intensified fears of global trade war, with some economists warning of higher inflation, disrupted supply chains, and increased recessionary risks. Um, Going to the clockwise to financial markets, obviously, because of this, we've experienced sharp corrections with equity markets losing trillions in value, at times down as much as 20% this year. And the US dollar is at its near 3-year low, which is unfortunate. Consumer sentiment is also impacted. It's plunged to its lowest since the 1980s, with spending expected to moderate significantly as households react to the price hikes and uncertainty. Just today, the Bureau of Economic Analysis reported that consumer spending, as measured by quarterly real GDP, shrank by 0.3% in the first quarter. And that might worsen in the second quarter, as many households are currently pulling forward their purchases in hopes of avoiding the worst effects of the Trump tariffs. From an inflation and recessionary risk perspective, inflation is set to remain elevated, with tariffs increasing input costs and feeding through to consumer prices. Risks of recession are elevated, with some forecasters estimating almost a 40 to 45% chance of a downturn in the next 12 months. So, what are some other macroeconomic factors? Um, Unemployment is projected to rise from about 4.1% to around 4.5 to 5% by 2026 as job growth slows and business confidence falters. And the Fed Reserve and the rate cuts, Fed is under pressure to respond to slowing growth and rising inflation, this stagflation concept. And the Fed really faces a dilemma because tariffs are pushing up inflation, also threatening to weaken the labor market and growth. And that complicates what the Fed has to do from a monetary policy decision perspective. So whether they make 2 cuts this year or 4 cuts, whatever it is, it's going to risk compounding inflation. And that's really all up in the air at this point. Let's jump to real estate trends. So two halves, residential real estate first. Sales volume and prices. Existing home sales declined sharply, about almost 6% in March of 2025 compared to February. Despite this, the median existing home price hit a record for March again, almost 404,000, marking the 21st consecutive month of year-over-year price gains, which is amazing. Amazing from not necessarily a great perspective. Inventory. Inventory of unsold homes increased 8%, about 8.1% month to month, now at a 4-month supply. This rise in inventory offers some relief to those looking for homes, but remains below what is needed for a balanced market. From an affordability and mortgage rate perspective, elevated mortgage rates averaging about 6.83% for a 30-year fixed as of mid-April continues to dampen affordability and mobility and keeping many potential buyers on the sidelines. This recent modest decline in rates has spurred some uptick in mortgage applications and refinances, and it suggests that buyers are adjusting to this new normal. And then, so from an investor activity perspective, on the residential side, individual investors and second home buyers accounted for about 50% of the home purchases in March. And that's really unchanged from a year ago, with cash sales comprising almost a quarter of the transactions. But the first-time home buyer share remains historically low at about 32%. On the commercial side, we're overall seeing a market recovery because commercial property prices have stabilized, with Green Street Commercial Property Price Index up about 0.3% in March. And the sector is emerging from a cyclical downturn. If you think about the pandemic and what that did, especially to office. Now transaction volumes have risen a little bit, and property owners are responding to looming loan maturities and refinancing challenges, which I'll talk about in a bit. Going sector by sector really quickly, industrial remains the top performer. It's driven by e-commerce and logistical demands. Um, Leasing activity has normalized to pre-pandemic levels, and vacancy rates have edged up. Rents continue to rise, though. Average U.S. asking rents are up 61% from 2019, which is pretty amazing. Office is stabilizing. So as much as we talk about office being hit by the pandemic, office sector is stabilizing. The slow but positive trend to net absorption and rent growth, particularly in prime markets. Vacancy rates remain a little bit high, but the return to office movement is gaining traction. Retail, it has the lowest vacancy rate among the major sectors, around 4%, which is fantastic. With steady demand in suburban and Sunbelt markets, we're seeing that institutional capital is returning to the segment. Multifamily. So multifamily is a big segment. After a surge of new supply, vacancy rates have edged up a little bit, but robust tenant demand and high home ownership costs are supporting the sector. Rent growth has also slowed a little bit, but remained positive. And then lastly, data centers and digital infrastructure. Demand for data centers and digital infrastructure is accelerating. And think about AI, cloud computing, and digital economy. The demand is there for these new commercial units. Investment activity in the commercial space market is seeing a moderate recovery of investment activity with opportunities for long-term returns as cap rates have compressed slightly and property values appear to have bottomed. Um, so major events, other major events impacting real estate, interest rates, we talked about this, persistent inflation has kept the Fed Reserve from making significant rate cuts. We are expecting 2 rate cuts this year, but that would lead to borrowing costs staying at elevated levels. And then that impacts both residential affordability and commercial refinancings. And then, of course, tariffs and policy shifts. Because of the introduction, it introduces volatility, especially in commercial markets, and it also affects investor sentiment and stock market performance. Loan maturities, we are seeing a wave of commercial real estate loans coming due, 1.5 trillion, driving increased transactional activity as owners, again, are forced to refinance or sell. And then return to office trends, again, are seeing positive net absorption and rent growth. So what does that mean for you? Um, and so our perspective, our thesis is that you should continue to diversify, shift your strategy, not just from focusing on equities because we're seeing a up and down markets in the equity markets, but shift your strategy and we're seeing investors diversifying across property types. So um, from an investment perspective, residential, commercial, industrial, mixed use, but also into other type of passive asset class categories. And then across geographies as well. We'll talk about this in a little bit to mitigate risk and capture emerging opportunities. Remain conservative. Ensure that, yeah, you should go with people you know, like, and trust, but also remain conservative. Ensure your underwriting model, it has conservative assumptions. Exit cap rates should not be significantly lower than the entry cap rates. Fixed debt should be at a minimum 3 years, and they should have plans for extending that. Ensure that property has strong fundamentals, whether it's population growth, demand for apartments versus single-family residences, or low consumption rates. Next is tax shield. So as much as we talk about passive income, invest in opportunities which shelter your income, that income from taxes. So traditional commercial real estate, of course, has the ability to shelter a portion of that passive income with passive losses through cost tag and other type of depreciation, but it's not going to shelter active income. So consider both income producing investments and tax reducing opportunities. And we help our investors direct them to those tax reducing opportunities. And then lastly, create passive income streams. So fortify yourself against financial market fluctuations, inflation, and recessionary risk. We're seeing unemployment rates rise. So having a 4 to 6 month reserve of cash, as well as a portfolio of dividend and passive income producing assets in alternative assets will help buttress against any unforeseen events. So that's the market. Let's talk a little bit about the performance of our portfolio. So firstly, we're really proud to showcase Clive Capital top line investment metrics. Again, together with Clive Capital, we're investing in our investors. We're investing in over 1,000 multifamily apartments under renovation, 500 single family rental homes under development, more than 350,000 square foot of industrial commercial real estate, and then 16 oil and gas wells. And we're expanding into other asset classes as well as private loans, private debt, and others. So from a geographic diversity perspective, this map shows some of the areas where our asset classes, our investments are located. That being said, our debt fund, together with our partners, we're lending to over 46 states. So it would be kind of absurd to populate icons for 46 states here. But just know that we're lending to 46 states. So we're continuing to diversify our portfolio of investments to reduce risk, all while uncovering the highest returns that meet our conservative buy box. So now let's talk about the performance of the investments themselves. So the first one, Gables at Cornerstone, um, the operator being Rockbridge. Gables has performed really well, 96% occupied, 100% pre-leased. And then for the month of March, we produced 67 new leads, roughly a 100% increase month over month from February. And they have locked in roughly 40% of those May and June renewals. And they're continuing to have those conversations to continue locking in and reducing turnover on site. You'll see the return metrics here, 6.25% annualized versus a 6.3% projected. So very much in line with what was projected, along with the 16% projected IRR for the entire investment. The next one is with Lone Star Capital, HFC, Beckland, Highland, and Meritage Apartments in Houston, Texas. The summary is that all three properties are doing well, steady through Q1, maintaining about 85% occupancy for Highland and stable collections. They're seeing a surge of leasing interest, which is great. Beckley, similarly, the occupancy rose from 83 to 91%, driven by 34 new move-ins during the quarter. And then Meritage remained stable, fantastic pre-leasing at 94%. They anticipate to be 95% occupied by May, and then 70% of the residents are renewing this quarter. And you'll see, again, the actual annualized distribution, 6.3, is pretty much in line with the 6.9% projected. And then you also see the IRR of about 16%, 15.8% projected for the project. Lone Star again, this is Timberwalk Apartments in Houston, Texas. In this particular investment, Lone Star has implemented a strategic repositioning of the Timberwalk Apartments, both at the corporate and on-site level to correct some operational inefficiencies. You'll see that reflected in the actuals, 2% versus a 6.2% and a 16.3% IRR. Lone Star is expecting that moving forward, that they will have this new strategy operationally will get them and the investment back on track. The Crest on Colorado, this is built to rent. Operators legacy acquisitions. You'll see a picture here. Fantastic movement so far. Total of 58 units in various phases of construction. 14 of them has received the certificate of occupancy, so they're eligible for leases, and 9 of these are move-in ready. 15 units are projected to be ready by the end of next month, pending final construction and city inspections. Again, the return metrics are 20%, about 20.4% projected IRR, 7.7 yield on cost, and then about 2.24% equity multiple.
I'll clarify that was a ground up development also.
Ground up
So
development, that's right.
no cash flow for, the first couple of years of the development until the units are leased up
That's right. That's correct.
and
Thanks for that.
refinanced.
Yep. The next one is through Mag Capital, their Industrial Fund 3. This is a commercial triple net industrial commercial opportunity. We acquired our first acquisition, Robbins Sports Surfaces, and they've delivered very strong results and have had momentum year over year. For example, they've secured a high-profile NBA in-season tournament court contract. And then the proceeds of the sale to Mag Capital, they were used by Robbins Sports to pay down debt and add additional liquidity to their balance sheet. And then they ended the year with record backlog and strong operational metrics. So fantastic acquisition. Again, the financial metrics, 14 to 16% IRR, 6 to 8% annualized distributions, and then 1.95x equity multiple. Mezzanine debt fund through Bozeman. So I put various here because it's various locations against 46 states. So in February 2025, they distributed 18.65% annualized. This is against a 16 to 18% projected annualized distribution. So fantastic. They're overperforming. The fund has about 15.6 million invested in short duration mortgages on a total principal of about 222 million. They continue to be conservative on their core credit metrics. So loan to as is value is 68%, which is pretty low. And then average FICO score is 765, which is fantastic. It's high. Zero defaults year to date, and only one since the inception of the fund. So it's a fantastic opportunity.
And they've issued over 700 loans or so, 150 of
Correct.
which have already been paid back, just to put that one default within some perspective.
Yep. Yep. It's a fantastic opportunity. DW, so this is oil and gas. DW Select 4 Fund at Anschutz and Continental, with Anschutz and Continental as the operators. This is with DW Energy Group. The investors have received their 85% tax write-off. This was closed at end of 2024 for their investments based on intangible drilling costs on their 2024 tax return. And then the 5 Anschutz wells will be online and producing shortly. And then the 3 Continental wells will spud in either Q3 or Q4 of this year. Again, they're projecting 2 to 4x lifetime equity multiple, and then 24 to 36 months return on capital based on a $70 a barrel of oil.
Well, I'll also point out there that the tax write-offs, unlike real estate, the 80 to 85% loss, meaning for every $100,000 invested, you can show a K1 loss on your taxes of 80 to $85,000. In real estate, that loss is typically restricted to only offsetting passive income. In oil and gas, because the tax benefits are just that much better than even real estate, as much as we love real estate. In oil and gas, the tax benefits allow you to not only write off or reduce your passive income, but also your W-2 income, active income, capital gains, any sort of income without any limit. As far as our CPAs have told us, obviously everyone's situation is going to be different, but that's one big thing that I'll point out. A lot of tax strategies out there will either reduce only passive income, or if they reduce all types of income like oil and gas does, it's usually capped to about 50% of your AGI, adjusted gross income.
Oh, that's fantastic. So current opportunities, we have a few that we will talk about at a future date. But we do have one, and we do have a couple of other ones that are continuing. Of course, Mac Capital with the industrial commercial real estate, Bozeman with the mezzanine debt. And then we have this new one that we're actively raising for DW Select 5 Fund, Bakken. Again, this is with the DW Energy Group and operated by Coda and Slawson, two of the major producers, operators in the Bakken region. There are 8 wells. Offering size is about 7.75 million, approximately 4.5 million of which have been already funded. So if you're interested, reach out. Estimated 2.6x return over the 20-year lifetime of the wells, roughly 20-year lifetime of the wells, with 80% of that in the first 5 to 7 years. And then again, the 24 to 36 month return of capital at the $70 oil, and then 80% estimated tax loss in year one.
So here again,
Oh, sorry.
I keep interrupting as we move to the next slide. That 80% tax loss is going to, again, offset any type of income that you have, as far as our CPAs have told us. I've invested with this company back in November of 2023, was able to reduce my Meta W-2 taxable income. John invested in December in DW Select 4 and was able to write off close to six
It,
figures as well
yep.
off of his taxes at Amazon. As John mentioned, the two other opportunities we mentioned that are already in our portfolio, Mag Capital and Bozeman, even though we have had closings and have made progress so far, those opportunities will stay available for the next year or so. On the other hand, this opportunity here, DW Select 5, we expect to close by the end of this month, end of May, I should say.
Okay, very good.
And with that, we'll get into the company updates, everything that we have been working on to become a better investment company, better fund management company here at Clive Capital. As far as progress, I'm very excited to announce that Clive Capital Fund C has hit over $1 million in assets under management, AUM, in just 6 months since we launched back in October. Given that this was amid the political and economic turmoil that we have seen so far, we think that's pretty good, but we could obviously do better. That's what we're working towards. We have added two new asset classes within this fund specifically, which we're really excited about. Industrial real estate within that fund. We've added private debt as well with the Bozeman Fund. And oil and gas, although it's outside of this fund, is another asset class that we have added and continue to see as a staple of our portfolio going forward. Set up an investor relations email now, just with all of the momentum that we're seeing, everyone who's starting to pick up on the progress that we're making here at Clive, the investments that we're offering to them, the returns, the tax write-offs, the transparency, all of that good stuff. There's too much work to do for all of us. So we've set up an IR at clivecap.com email so that I'm not the bottleneck here alone, so that the entire team can help get back to you as soon as possible with a prompt answer to any questions or concerns that you have. And lastly, we are celebrating our podcast's first birthday. The podcast is called Investing for Generational Wealth. We're on YouTube, Spotify, Apple Music, all the major platforms. Go check us out there, give us a listen, and if you love what you hear, do us a huge favor and hit that subscribe button, leave the 5-star review, provide us feedback on what we're doing better, what kind of topics you want to see more of in the future. But yeah, that's 1 year with almost, is it 60 episodes exact or
It's almost exactly 60 episodes. That's correct.
almost exactly 60 episodes? We post one approximately every week. Sometimes we double up if we're feeling generous, but that's a pretty good way to keep up with what we're doing. Our goal here is to build wealth, generational wealth for ourselves, for our families. That doesn't just come down to investments. It comes down to learning about taxes, about accounting, about legal structures. And so there's a lot of different experts that we bring in to educate ourselves, and then whatever we learn, we like to educate our audiences as well. And that's really the goal of the podcast, is to spread awareness and financial education so that we can all play by the same rules that the ultra wealthy are playing by too, and build that, financial freedom, passive income life for ourselves and our loved ones. Next, we're very excited to announce overhaul of our website, clivecap.com. John's worked very hard on the website over the last few years, and we then took all of that, worked with a marketing agency to really revamp it and clean it up. And we're excited. So again, please visit our website, clivecap.com. Leave us some feedback. We'd love to hear from you on any new information you want to see, any suggestions. And with that, what is next? It was a busy Q1. It's going to be an even busier Q2. That's just how these things are. So what to expect next? Some of the things that we're up to in Q2, we're hosting our first ever investing meetup in the Bay Area in Fremont, California on Saturday, May 24th. That is Memorial Day weekend, which I didn't realize at the time, but definitely reach out. Here are the details. It's from 11 to 2 p.m. Pacific. It's going to be located at the Liberty Room at the Fremont Downtown Event Center. Here's the address. And we will be catering Indian food. So, food and investing are some of my two favorite things in this world. I'm
Mhm.
sure that probably relates to a lot of you listening at home. So, why not do the two at the same time? We are also working on a detailed fund performance report where we will be able to show our investors, current and also prospective investors, anyone who's interested, what our portfolio composition is, what percentage of the portfolio is in oil and gas, what percentage of it's in built to rent, what are the returns of each of these asset classes, how much capital have they returned so far, where our investments are, where are investors coming from in the country, and how are they investing? Are they using cash? Are they using their retirement accounts? Are they using leverage like, HELOCs, home equity lines of credit, and other statistics like we were showing earlier in our portfolio performance, what did we project and what did we actually achieve? And other things that we'll be incorporating is just comparing our performance to the golden standards, the benchmarks of investing, like the S&P 500, the Magnificent Seven, and tech stocks. Trump coin, only the most stable asset there is out there, and other crypto, because we want to show you objectively how we are stacking up against your alternatives. And so that's something we're pretty excited about. We're also learning more about advanced tax strategies, even beyond oil and gas, to further passively and legally take our taxable income down as close as possible to $0 a year. And with that, that's it for today. Unless, John, there was something else that you wanted to
No,
cover here.
I think that's great. I think that's a fantastic update for Q1. We will come back with another update in Q2 of this year. If you have any questions, feel free to reach out to either Keshav or me. You have the QR code as well as the ability to schedule a 30-minute call with us. We're always open to answering any questions. And of course, we always want to see you, our investor, succeed with the passive income and diversify across multiple asset classes.
Yeah. All right. Well, thanks so much, everyone, for listening. That was Q1 for Clive Capital. And in another 3 months, keep on the lookout for Q2.
Sounds good. Thanks, Keshav. Thanks, everyone.
Thanks, John.